Hello, I'm going to talk about diversification again today. I know I've talked about this subject in the past, but it's an important enough subject where I am going to discuss it again. Now, my belief is that despite the entire commercial investment industry all over the world employing diversification as their top strategy for all their clients, that diversification is just pure rubbish. Just because someone says something is so and has been saying it for 100 years does not make it the truth. Prime example of this is if you look at every U.S. Treasury Secretary since the Nixon administration, whether that Treasury Secretaries come from Citigroup, Goldman Sachs, or the Fed Reserve Network, like Tim Geithner, they've always touted a strong dollar policy, but the actual behavior of the dollar has belied their words for decades upon numerous decades. As you know, the dollar in recent times has lost as much as 50% of its value in about 8 years, and 96 to 98% of its purchasing power since the inception of the Fed Reserve. So diversification is the same thing. It's basically a false concept, and it's a fraudulent concept that the commercial investment industry desires everyone to believe. So they've been touting this strategy for as long as they've been around, for decades upon decades upon decades. But just because they say it again does not make it so. Now, if I compare it to any other industry, if you look at, say, for example, surgery, I remember encountering a vascular surgeon who once, said to me, surgery is quite easy, and he said the point where it becomes difficult is if things do not go as planned. So, if everything always went as planned, he said, almost anyone could become a surgeon, because if as long as everything goes perfectly correct, it's not that difficult. But the skill of a surgeon comes in to play when things don't go quite as planned. Now, I look at investment as the same investment strategies as a great analogy to that example, or great corollary to that example, because diversification is great if everything goes as planned. So in a bull market that existed in the 1980s, early 1990s, which I guarantee you those days are over, just because of the enormous bubble of fiat currencies and the enormous manipulations of governments and other financial regulatory commissions that are necessary now to keep markets rising off fraud rather than fundamentals. That diversification will serve you well if the stock markets go up, but so what? I mean, that's stupid to give money to an advisor to diversify, because you might as well just buy like an index fund, because diversification rarely results in a great yield over what the index is yielding. So what if you get 4 or 5% more than the index, because you could probably cherry pick a couple stocks on your own, and with a little effort and a little research, and achieve those results on your own without really ever paying 1 to 2% of your assets to achieve that. Now, studies have shown that, and I've spoken about this in the past, like you could take a monkey, pin his feet, have it jump on a newspaper that has all the stocks that comprise your country's index, and experiments in the past have shown that it's a 50-50 bet whether that monkey beats the top fund managers in your country that year. So it's all pure luck. Diversification, it's luck on the upside. So because it's luck on the upside and there's zero skill that's involved, it's never going to protect you on the downside. And that's what you want. That's where skill comes in. If it's if your advisor is actually skilled, then they will not diversify, because diversification never protects you on the downside. And another example of this would be like if you're an athlete and you watch basketball games, there are certain players, even at the professional level, that have reputation as just having the worst J's. They're not a good jump shooter. They can drive and score, but they can't. They just don't have a jump shot they can depend upon. But if you go watch them pre-game before practice, you might be amazed, because they might drain like 15, 20, 25 J's in a row. You say, how come they can't do that when it comes down to the real life situation? But the real life situation, they don't have a hand in their face. They don't have the pressure of making a game-winning shot, or when the game's on the line, there's 2 minutes left in the game, they don't have to make those shots. And it's not comparable to a practice situation. So that's what diversification is like. It's like diversification is like practice. There's no pressure. The markets are up. Everything goes well. But when the markets start falling apart, how does that protect you? And I think you're going to see, it's possibly as early as in the next couple of weeks, because the Western stock markets may start correcting on a serious, significant level in the next couple of weeks, we'll probably know if this is going to happen. And then you'll see that diversification won't protect you, because I guarantee you portfolios will be just as much down as the indexes are if you're one that adheres to diversification and subscribes to that theory. So with these markets, I know those of you that follow me on Twitter, as a quick aside, that a couple of weeks ago when the S&P reached 1093, I said it was a good time to short. Just 3 days later, the S&P lost more than 3% in a single day, and had you cashed out at that point, you would have made a nice healthy profit, depending upon whether you played slightly out of the money put options or slightly in the money put options. You could have made anywhere from 50 to about 80-90% profits on that if you had you closed it out that day. So the important point is, when you have a trade, if you're taking a trade, is to close out your positions very quickly when they're up, because in this fraudulent market, where basically it's like the Terminator, Skynet, high frequency trader, computerized programs at JP Morgan and Goldman Sachs controlling the entire market, you really can't beat these computerized algorithms, so you don't want to try. So when you have a profit, especially in this low volume environment, if you're shorting the market again and it goes down like that day heavy but on light volume, you need to take your profits, because the next day is probably going to be back up and those profits will be gone. I would only say stay in the market, whether you're trading up or down, if the volume is very, very high. But right now we've had a low volume market for a very, very long time. And in fact, the latest stats from the ICI just showed we had the 13th consecutive week of significant outflows in domestic mutual funds in the United States. So, when's the last time you remember a market rising when there's huge domestic outflows every week? And in fact, year to date, it's almost $50 billion have been redeemed in mutual funds in the United States. So I guess the one encouraging thing is that retail investors, because this is a retail investor thing, it's actually a great indication of the fraud in the market that retail investors are actually recognizing the fraud in the markets, because usually mutual fund investors are long-term, they're in it for the long term. So the fact that they're leaving, they're probably not going to come back anytime soon. Again, it's just another sign that of how fraudulent these markets are, how controlled they are by computers today, and how fundamentals have zero to do with stock market behavior today. But that's about all I have today on diversification. So we'll catch you on the flip side soon. Thanks.